Hey, this is Hutch with bankingtruths.com, and today I'm going to talk about the right way to analyze a whole life policy for both infinite banking and retirement. And the two main mistakes I see people commonly make is one, they say something like, I don't really care about the death benefit, I only care about the cash value. And that may be true, but if you do care about the cash value, you should care about the death benefit because the cash value must equal the death benefit by life expectancy. So it is going to be one of the biggest drivers of long-term performance and sustainability, especially if you're taking massive loans against your policy. The second mistake I see people making is the hyper focus on early cash value, and it comes from a place of realizing that the first years are the worst years with whole life. There's always going to be some kind of early missing equity from fees or costs or whatever. And their high yield savings account or their CDs, they have 100% cash value. So they begin and end by looking at the policy that has the least amount of money missing, and they just stop there instead of measuring and doing a true cost benefit analysis of what those early fees buy you, just like they do with any other major purchase decision or any other investment, like starting a business, starting a real estate investment. They do a thorough cost benefit analysis, and that's exactly what we're going to do here in this video, and I'm going to show you how it's done. All right, I'm going to start with the flow chart I made that really helps with the context of setting up, dissecting that early missing equity. And what I'm talking about is the first 2 years, he's paid two premiums of $10,000 each, $20,000 total. And of those two premiums, there's going to be a positive cash value component. $17,300 is showing up in cash value from that $20,000 from the first 2 years, which means $2,687 is missing, and nobody likes that. However, that's where people begin and end, is they say, how do I make that red box smaller? And I'll tell you, how to make the red box the smallest is just never do whole life. Just keep your money in high yield savings. You'll have 100% cash value, but you know cash is trash. You know that not only is it going to lose money to inflation, you're going to lose money to taxes every year, and you're not able to borrow against it while keeping it compounding for you. And so what you need to do is when you're looking at a policy, you need to analyze each of these boxes, the green box more thoroughly and the red box. And that's what we're doing right now. So for the green box, what we do is we stretch out and we look at the nominal IRR. That's the internal rate of return for the first 25 years is 4.97% in spite of starting at a deficit. In spite of only starting with 17,000 from the first 20, it still equals almost a 5% rate of return by the time this 40-year-old is reaching retirement. And by life expectancy, it is now up to over 5%. And that's nominal, meaning not considering taxes. If we consider that this gentleman is in the 24% tax rate only and taxes stay that low, that feels like earning 6.5% in a savings account by the time he hits retirement, as opposed to the right now it's about 3.75 maybe. You'd have to earn 6.55, pay the tax to have it equal what the cash value growth does here, and by life expectancy it's up to 6.7. And again, I realize people still like, I just don't like that. I want high, they want it all. I want the high early cash value too. Well, what you should be doing is looking at that 2687 and figuring out what benefits it buys you. And it buys you three. It doesn't matter which company, it doesn't matter what type of whole life policy it is. You always get three benefits for whatever amount of missing equity is there early. And the first benefit is the recaptured term savings. So by having a certain amount of death benefit over and above your cash value, not the total, because you're going to use the cash value, but death benefit over and above the cash value, we've measured, and I'm going to show you how, that this gentleman could have saved $5,000 of term premiums over 25 years. Now, would you prepay me $2,600 over the next 2 years to save $5,000 of term premium over 25 years? Probably not, but that's a benefit you get. You also get income taxes avoided. Just like we saw in the green box above, you get what feels like a much bigger rate of return, and we can calculate $44,000 of taxes have been avoided on your growth by the time this gentleman hits retirement. Now, most of you probably would say, if you went to Chase Bank and they said, look, we have this great high yield savings account, you can prepay $2,600 based on the projected performance of the savings account and save all taxes. We think it'll be about $44,000 over the next 25 years. Would you do it? Most people would say yes. And lastly, even if you don't care about the death benefit, there always is some sort of pure death benefit or net death benefit over and above the cash value, just like we measure with the term, but the term expires, it goes away. With whole life, there's always some amount of net death benefit over the cash by life expectancy. And in this case, it's 136,000. Again, would you prepay 2,600 over the next 2 years to have a $136,000 burial policy for your family? I mean, people are doing it. Fonzie's on TV selling these types of things. You may not, but it doesn't matter. You get it and you get all three benefits. So let's dig in deeper into how we got all these numbers. And by the way, if you want to request your own analysis like this, you can go to bankingtruths.com/x-ray. I designed all of this on AI and we can do it quickly and at scale. So if you have an existing policy or a policy you've been shown, go to bankingtruths.com/x-ray or go to just email me at hutch@bankingtruths.com and email me the illustrations and we can now do this at scale. If you're an advisor and you want to provide this type of analysis for clients, go to bankingtruths.com/AI and you can see how you can get access to these tools. Just to give you a heads up, here's the first 23 years of funding for this policy. It is max funded for about 8 years with that $10,000. Then there's these wonky numbers. That is the most amount of premium we can put in after that. So obviously we can do this for any premium schedule. This is just something that is optimized, or as we say, shrunk wrapped, whatever the right way to say it is, where it's the least amount of death benefit around the cash value. And we're just using a $10,000 premium. If that's too much for you, this may not be right for you. But if you're looking at doing a lot more, just consider this a unit and just look at the ratios. So with that, let's look at the cash value IRR. Again, we analyze this in the slide, but the high yield savings rate, I'm putting 4, but like I have Robinhood and I don't keep a lot of money in cash there. It's down in the 3s. Again, 4.97 just on its own 2 feet, even if tax benefits weren't benefiting you, because some people say this only works for people in the highest tax bracket. It's not true. At 24%, it turns a 4.97 return into a 6.55. And that amount of compounding that you're going to see in the next slide is a lot. By year 50, it's even better. And again, if taxes go up for you, even if you're at the 24% now, if you become more successful or they raise tax to pay for all this national debt or bombs or war or whatever, then this is going to feel even better. If we look at the nominal growth, the orange line is a high yield savings account at 4, taxable at only 24%. And you can see even after you stop premiums, this thing's kicking butt for a long time. The advantage is massive. It's a $484,000 advantage, or basically more than double you'd have in a high yield savings account. Not to mention, you're going to be spending, saving. So you're never going to build up that critical mass versus borrowing against whole life. You can. Okay, let's unpack the cost component, because that's where I think people really get tripped up. So again, we're going to look at those first 2 premiums paid, 20,000, only 17,000 is in cash value, 26 is missing. People don't like that. So how do we get those numbers? First year, 10,000 of premiums paid, only 8,200 showing up in cash value. That means 1,700 is missing from your equity. Even though you may have a savings account and it's been 10,000 forever, you weren't even going to touch that 1,700. So we're going to see what it buys you. Premium 2, you pay 10,000. It's not as bad. 9,000 of that 10,000 showing up, but still 927 is missing from it. So you add those 2 up. That's how we get those 3 numbers from the bottom. That's where people start and end. What they don't do is they don't say, what is this money buying for you? When they're buying a car, they don't have like cracked phones. They don't have like old jalopies. They don't live in tenement houses. They buy nice things, but they get a value and they do a cost benefit analysis. So again, you're going to pay less in term premiums. You're going to create an ongoing tax shelter that's worth something, and we can measure that. And last, you're going to have a permanent net death benefit, whether you care about it or not. That money's going to be reserved in the insurance company's vault, and it's going to go to somebody somewhere. So let's take a look. All right, let's look at the term insurance recapture. So you can see at the end of year 25, our 40-year-old will have 321,000 of cash value and 220 of net death benefit or pure death benefit above that, for a total death benefit of 541. I don't like to use total death benefit in the term recapture because they're probably going to be using their cash all along the way. So I only like to use the net death benefit, and it will vary year by year. But what's crazy is the whole policy started with only about 200,000 of death benefit total. And when he was 40, it would cost him $209 a year to take out just a basic non-convertible term policy, assuming that's for a 20-year term policy. I'm going to give him 25 years. It would be more expensive, but I'm rounding down. And if we measure the net death benefit each and every year for the 25 years at that rate of 209 per 200,000, he's going to save about $5,000 of term premiums just by having this policy. And so again, you probably wouldn't prepay $2,600 over the first 2 years to save $5,000 over the next 25, but it is a benefit you get. And the other great thing about the death benefit, even if you don't care about it, is that's what provides the tax shelter. Term insurance will expire, but the permanent death benefit is what provides you the tax shelter. So even though you may not prepay for the term insurance, most people would prepay $2,687 to avoid $44,000 of taxes by age 65. Now, what I'm showing here is if you didn't have a tax sheltered account and you essentially just kind of prepaid $2,600 to cover all the taxes due, if you had a super juiced up savings account at JP Morgan Chase or Wells Fargo, because you're avoiding $44,000, you don't need to pay those $44,000 of taxes along the way. And that's the work that $2,600 would have done for you. And if I ask you, would you prepay that today to avoid those taxes over 25 years? Most people would say yes, because it's a heck of a deal. In fact, this is just a net present value calculation. We're saying if you need to pay off $44,000 of tax by year 25, you'd need $2,600 sitting in a savings account earning 12% to just handle that bill for you. And if we look at what the total benefits are by year 50, so in this case, this guy's age 90, we're going to look at the same 2,600. His IRR's gone down to not 12, but almost 10 and a half. And that's because we stretch out the time frame for 50 years. So what we're saying is essentially 2,600 earning about 10.5% every single year for 50 years provides these two benefits for him. One is the pure net death benefit over and above the cash value that he can't use, he can't touch while he's alive, but it's almost like it's sitting in the insurance company's vault waiting for him. The other thing he gets that he can use while he's alive is the $240,000 of total tax. We saw by year 25, it was $44K of tax. By year 50, it's compounded to almost $250,000. So if we add these two numbers up, that's a combined 376. We just take the purple 136 with the blue 240, that's 376. My partner didn't want me to show this because it sounds too good to be true, but it's not. I can show you the math. If you request an x-ray, we can actually have it spit out a spreadsheet to show you how we got this. But essentially, the 2687, it's like it's sitting in that insurance company's vault doing work at about 10.5% to provide these 376,000 of total benefits for you. And here's the math: the net death benefit, the avoided tax, combine them 376, take the missing equity. That's what kind of steady return it needs. And keep in mind that this doesn't even include the $5,000 recapture that you get back over the first 25 years from not having to pay for term insurance. All right, so let's put it all together and look at age 90. So what's he get? He's got 1.1 million of cash value. It grew to be a lot bigger than it otherwise would. Why? Because of the tax sheltering from the permanent death benefit. And it doesn't matter how much permanent death benefit is delivered. In this case, only 136,000 over and above the cash value. But because a death benefit's being delivered, he gets to avoid 240,000 of taxes along the way. And speaking of that too good to be true, I once was giving this presentation for an insurance company, and one of the employees said, I don't know if we can get this past compliance. And I said, why not? And they go, well, how can you say he's avoided that much in taxes? And I said, well, if he cancels the policy at age 90, how much will he owe in taxes at a 24% bracket? 240? Why can't I say it? And the guy said, touche, you're right. And this is a much smaller number, but granted, he gets this number a lot sooner. The 5,000 of term savings he gets over the first 25 years, which is almost double that 2687 that was missing for the first 2 years. And again, the total death benefit is 1.27. That's just adding the 136 in purple plus the 1.135 in blue. And that's from 135,000 in premiums over the 23 years. And if we look at this summary that I did for every 5 years, what you can see is everything in one place, except for that term recapture, which, okay, we already discussed it. But I also use annual return instead of IRR because I think that tells a better story. That's your hurdle rate if you're borrowing against it. It's also if you're using this as a high yield savings replacement or bond replacement for retirement. Some people are straight up using this in exchange for market-based assets because once you look at the taxable equivalent return, you really are getting close to market rates of returns, only without the volatility and with the pure liquidity that you could be using this along the way to invest in other assets that will cash flow for you. At any rate, I hope you found this helpful. Again, if you're looking for your own analysis for an existing policy you have, policies you've been looking at, or you want us to design one from scratch, go to bankingtruths.com/xray and request one for yourself. Or you can just email me at hutch@bankingtruths.com. It is actually me manning the email. I do reply. And if you're an advisor and you want to provide these types of analytics for your clients, go to bankingtruths.com/AI to get all the details. Hope this helps, and we'll talk to you soon.